China's economy is showing clear evidence of weakening again, with the property sector remaining at the epicenter of the slowdown. Fixed asset investment, which tracks spending on items like buildings, factories, and machinery, rose just 1.6% in the first 7 months of the year, relative to 2024. That was down from 2.8% in the first half and weighed down by a 12% drop in property investment. Outside the pandemic, it was the weakest result on record. Looking at the property sector in more detail, sales by floor area fell 4%, while new construction starts tanked nearly 20%. New home prices fell 0.3%, with all bar 10 cities reporting declines. Now, the property downturn is clearly spilling over into consumption and manufacturing via a negative wealth effect. Retail sales grew just 3.7% on a year earlier, the slowest pace since December, while industrial production slowed to 5.7%, hitting 8-month lows. Weak housing activity is reducing household demand, and that's contributing to softness in consumer prices and outright deflation in upstream sectors like manufacturing, where prices continue to fall. Now, policymakers are trying to counter these trends. They've recently allowed some workers to use retirement savings to help buy homes, easing access to other consumer finance, along with tasking some state-owned funds to purchase properties outright. But with demand fragile and developers remaining under pressure, these steps face an uphill battle. China's property slump, combined with weak retail and industrial activity, shows that the growth challenges remain broad-based and far from over, even before trade uncertainty is considered.